Let me tell you about the 5 stocks I would buy for my grandchildren if I could only choose 5. Not for next year, not for the next decade, for the next 50 years. These are businesses I want my grandchildren to own when they are my age. Businesses that will compound wealth across generations. Businesses so good, so durable, so essential that they will thrive regardless of what happens to the economy, to technology, to politics, to anything. I am 94 years old. I have been investing for over 80 years. I have seen every type of market environment, depressions, recessions, wars, technological revolutions, inflation, deflation, everything, and I have learned that the vast majority of businesses do not last. They get disrupted. They lose their competitive advantages. Management makes mistakes. Industries decline. Most companies that are dominant today will be forgotten in 50 years, but a tiny handful of businesses have characteristics that make them nearly immortal. They serve fundamental human needs that will never change. They have economic moats so wide that competition cannot cross them. They have business models that generate enormous cash with minimal capital requirements. They have management cultures that prioritize long-term value creation over short-term results. These are the businesses I want my grandchildren to own. Today, I am going to tell you exactly which 5 stocks I would buy for my grandchildren. More importantly, I am going to explain why these specific businesses can compound for the next 50 years. I am going to show you what makes them different from the thousands of other companies that will fail or stagnate. And I am going to give you a framework for thinking about generational wealth that you can apply to your own family. Before I reveal the 5 stocks, let me explain how I think about buying for grandchildren versus buying for myself. When I invest Berkshire Hathaway's money, I have a 10 to 20 year time horizon. I am 94. I probably will not be around in 20 years, so I think about what will happen over the next decade or two. But when I think about my grandchildren, I am thinking about the next 50 to 70 years. They are in their 20s and 30s now. They will live to their 80s or 90s, hopefully. That is a completely different time horizon. With a 50-year time horizon, many things that matter in the short term become irrelevant. Recessions do not matter. Bear markets do not matter. Even decades-long secular trends do not matter much. What matters is the fundamental durability of the business model. Can this company still be generating value in 2050 and 2070? That is the question I ask. The other thing about buying for grandchildren is that I am not trying to maximize returns. I am trying to minimize the chance of permanent capital loss while achieving good returns. If I buy a stock that compounds at 12% for 50 years, $1 becomes $290. If it compounds at 15%, $1 becomes $1,083. The difference between 12 and 15% is enormous over 50 years. But the difference between 12% and 0% is catastrophic. So I prioritize safety and durability over maximizing returns. I also think about taxes differently when buying for grandchildren. If I buy stocks today and my grandchildren inherit them, they get a step up in cost basis. This means they inherit the stocks at the current market value, not my original purchase price. All the capital gains I accumulated disappear for tax purposes. My grandchildren can sell the stocks immediately and pay zero capital gains tax. This is an incredible tax advantage. It means I want to buy stocks that I never have to sell, stocks that can compound in the portfolio for decades without requiring any trading or rebalancing. Buy and hold forever is the strategy. With that framework established, let me tell you the 5 stocks I would buy for my grandchildren. The first stock is Visa. Not the credit card company, but the payment network. This is one of the best businesses in the world. I do not own it personally in size, which is a mistake I regret. But if I were buying for my grandchildren, Visa would be the first stock I would buy. Let me explain what makes Visa so extraordinary. Visa does not lend money. They do not take credit risk. They do not issue cards directly to consumers. What Visa does is operate the network that connects banks, merchants, and cardholders. When you use a Visa card to buy something, the transaction runs through Visa's network. Visa charges a small fee for processing that transaction. That is the entire business model, and it is absolutely brilliant. The beauty of this model is that Visa makes money on every transaction regardless of whether the consumer pays their bill. If you buy something for $100 with a Visa card and never pay your credit card bill, the issuing bank loses $100. Visa already got paid their fee when the transaction was processed. Visa has no credit risk, no lending risk, no default risk. They just process transactions and collect fees. This is why Visa has never had a losing year in its entire history as a public company. The business model also requires almost no capital. Visa does not need to build factories or stores. They do not need inventory. They do not need to hire millions of employees. They operate a digital network. The marginal cost of processing one more transaction is essentially zero. Once the network is built, incremental transactions flow through at nearly 100% margin. This is why Visa has operating margins over 60%. For every dollar of revenue, 60 cents is operating profit. This is extraordinary. Visa also benefits from powerful network effects. The more merchants accept Visa, the more valuable it is for cardholders. The more cardholders have Visa, the more merchants want to accept it. This creates a virtuous cycle that makes Visa more dominant over time. And because everyone is already using Visa, switching to a competitor is difficult. Merchants do not want to drop Visa because they would lose access to millions of customers. Consumers do not want to drop Visa because merchants might not accept their alternative card. The network effects create an economic moat that is nearly impossible to cross. Now let me talk about the long-term growth opportunity. Visa operates in nearly every country in the world, but the vast majority of global transactions are still done in cash. In the United States, about 70% of transactions by volume are electronic. But globally, only about 40% of transactions are electronic. The other 60% are cash. As the world continues to move from cash to digital payments, Visa captures a growing share of total transactions. This trend has decades left to run. Emerging markets are particularly important in India, China, Africa, Southeast Asia. Hundreds of millions of people are entering the middle class for the first time. They are getting bank accounts. They are getting payment cards. They are moving from cash to electronic payments. Visa is positioned to process the vast majority of these transactions. This is a growth runway that extends for decades. Visa is also expanding into new payment types. Real-time payments, business-to-business payments, cross-border remittances, cryptocurrency, on and off ramps. Every new payment type is an opportunity for Visa to expand their network and collect fees. And because they already have the network infrastructure and the relationships with banks and merchants, they can enter new payment types at minimal incremental cost. The company is also remarkably shareholder-friendly. Visa buys back enormous amounts of stock every year. Over the past 10 years, they have reduced shares outstanding by about 30%. This means your ownership percentage increases every year without you doing anything. Combined with revenue growth and margin expansion, this drives earnings per share growth in the mid-teens consistently, and they pay a growing dividend currently yielding about 7%. Visa trades at about 30 times earnings. This is not cheap, but for business with 60% margins, no capital requirements, powerful network effects, and decades of growth runway, I think it is fair value. Over the next 50 years, I expect Visa to compound at 12 to 15% annually. My grandchildren could turn $10,000 invested in Visa today into $300,000 to $1 million by the time they retire. And Visa will still be processing payments in The risks are worth discussing. Regulatory risk is real. Governments and consumer groups complain about interchange fees. There have been lawsuits and regulatory actions, but Visa has navigated these successfully for decades. The fees are small enough that consumers do not notice them, and the value Visa provides to the payment ecosystem is so large that eliminating them would be destructive. Cryptocurrency is sometimes mentioned as a threat. I am skeptical of crypto as an investment. But even if crypto becomes mainstream, someone needs to process the on and off ramps from crypto to fiat currency. Visa is positioning themselves to be that processor, so even a crypto future is not necessarily bad for Visa. The second stock I would buy for my grandchildren is Costco. This is a retailer, but not a normal retailer. Costco has a business model that is fundamentally different from every other retailer, and that business model has proven durable for 40 years and will likely remain durable for the next 40 years. The key to understanding Costco is understanding that they do not make money from selling products. They make money from membership fees. Costco operates on a membership model. You pay $60 to $120 per year for the privilege of shopping at Costco. This membership fee gives you access to a warehouse where products are sold at the lowest possible prices. Costco operates on razor-thin margins on the products themselves, typically 2 to 3%. They price products just above cost. The profit comes entirely from membership fees. Last year, Costco generated about $4.5 billion in membership fee income. Their total operating income was about $7.5 billion. So 60% of their profits come from membership fees. Only 40% come from selling merchandise. This is the opposite of normal retailers who make all their profit from marking up products. Why does this matter? Because it aligns incentives perfectly. Costco wants you to renew your membership year after year. The only way you renew is if you get value from shopping there. So Costco was incentivized to provide the absolute lowest prices and best value. If they marked up products like a normal retailer, you would not renew your membership. So they price everything at cost. This creates incredible loyalty. Costco has a membership renewal rate over 90%. Once you become a member, you almost never leave. This makes the revenue stream highly predictable and sticky. The membership model also creates a moat. Other retailers cannot compete with Costco on price because Costco is not trying to make profit on the products. Walmart, Target, Kroger, they all need to mark up products to make money. Costco does not. So Costco can undercut everyone and still be profitable. This makes it nearly impossible for competitors to win Costco customers away. Costco also has the best supply chain and operations in all of retail. They have incredible buying power because they move huge volumes. They negotiate better prices from suppliers than anyone else they have. Limited SKUs, only about 4,000 products versus 50,000 at a typical grocery store. This means they buy each product in enormous volume. They turn over inventory very quickly, about 12 times per year. This means they do not need much capital tied up in inventory. The entire model is capital efficient and operates like a machine. The culture at Costco is also unique. They pay employees well above minimum wage. The average wage is about $25 per hour with benefits. This attracts good employees and reduces turnover. Happy employees provide better customer service, which increases member satisfaction, which increases renewal rates. The CEO, Craig Galan, who recently transitioned to Ron Bacris, came up through the ranks over decades. They understand the culture. They prioritize long-term value over short-term results. This is the kind of management I want for a 50-year hold. Now let me talk about growth. Costco has about 600 warehouses in the United States and another 300 internationally. They open about 25 to 30 new warehouses per year. Each new warehouse generates about $200 million in annual revenue once mature. So they are growing revenues by 5 to 6 billion per year just from new warehouses. They are also expanding internationally. Costco is in Mexico, Canada, Japan, Korea, Taiwan, UK, France, Spain, Iceland, Australia, China. Each new country is an opportunity to replicate the model. China alone could eventually support several hundred Costco warehouses. This is a multi-dead growth opportunity. Costco trades at about 45 times earnings. This seems expensive, but remember that most of the profit comes from membership fees, which are recurring and growing. The membership base grows every year. The fee increases every 5 to 7 years. Last time they raised fees was 2017. So another increase is coming soon. When they raise the fee from $60 to $70 for basic members, that is a nearly 17% increase in membership fee revenue. This drops straight to the bottom line. Over 50 years, Costco could increase membership fees 5 to 7 more times, while also growing the member base. The compounding is powerful. I expect Costco to compound at 10 to 12% annually over the next 50 years. It is not as fast as Visa, but it is very safe. Costco will still be operating warehouses in 2070. People will still need to buy groceries and household goods. The membership model will still work. My grandchildren will likely be Costco members themselves. This is a business built to last. The risks are manageable. Amazon is sometimes mentioned as a threat, but Costco is not trying to compete on convenience or selection. They compete on price and value. Costco is also a destination. People enjoy going to Costco. It is an experience. You never know what you will find. This is hard for Amazon to replicate. Walmart is a more direct competitor, but Walmart does not have the membership model. They cannot match Costco's prices consistently. The biggest risk is probably execution. If management gets complacent, if they stop focusing on value, if the culture deteriorates, the business could suffer. But so far, this has not happened in 40 years. I am confident the culture will persist. The third stock I would buy for my grandchildren is Berkshire Hathaway. This is obvious because it is the company I have spent my life building. But it is not just nepotism. Berkshire is structured to last for generations. We have thought carefully about succession, about culture, about durability, and I believe Berkshire will be thriving long after I am gone. Let me explain what makes Berkshire different from a normal company. Berkshire is not really a company. It is a collection of businesses, investments, and cash-generating machines. We own over 60 operating businesses, completely insurance companies like Geico and General Re, a railroad, Burlington Northern, utilities and energy companies through Berkshire Hathaway Energy, manufacturing businesses like Precision Cast Parts, retailers like See's Candies, industrial distributors like TTI. We also own major stakes in public companies like Apple, Coca-Cola, American Express, Bank of America, Chevron, Occidental Petroleum. This extreme diversification is unusual and powerful. When one business struggles, others thrive. During CO, GE, ICO, and our insurance businesses were weak because people stopped driving and claims were uncertain. But our railroad and utilities kept generating cash. Our food businesses like See's Candy struggled with store closures, but our online businesses grew. The diversification creates stability. Berkshire has never had a losing year, not in 60 years. This is extraordinary, and it is because of diversification across businesses and industries. Berkshire also has the best capital allocation culture in the world. We do not waste money on ego. We do not make foolish acquisitions to grow for growth's sake. We do not pay dividends just because other companies do. Every dollar we earn is either reinvested in our businesses where we can earn high returns, used to buy back stock when it is undervalued, or deployed into new investments when we find attractive opportunities. If we cannot do any of those things, we hold cash and wait. This discipline has compounded Berkshire's value at about 20% annually for 6 decades. The management succession is also in place. Greg Ayl will run Berkshire after I am gone. He has been with the company for decades. He ran Berkshire Hathaway Energy and grew it into one of the largest utility companies in America. He understands capital allocation. He understands the culture. He will not try to change things or make his mark. He will continue what we have built. This is critical. Many great companies fall apart after the founder leaves because the successor tries to do things differently. Greg will not make that mistake. Berkshire also has a fortress balance sheet. We carry about $150 billion in cash in short-term treasuries. We have almost no debt at the parent company level. Our insurance companies are conservatively reserved. We can survive any economic environment. During the 2008 financial crisis, we had capital to invest when everyone else was desperate. We bought Goldman Sachs, General Electric, Bank of America. We made billions. This ability to act when others cannot is valuable, and it requires a strong balance sheet. Now let me talk about what Berkshire will look like in 50 years. We will still own excellent businesses that generate cash. Some of today's businesses will have been sold if they stop performing. New businesses will have been acquired. The public stock portfolio will have changed, but the core model will remain the same. Own good businesses. Allocate capital wisely. Maintain a strong balance sheet. Think long term. If my grandchildren inherit Berkshire stock and do nothing but hold it, they will be very wealthy. Berkshire trades at about 1.4 times book value currently. This is reasonable. Our intrinsic value is higher than book value because many of our businesses are worth more than their carrying value on our balance sheet. But we are not expensive. I expect Berkshire to compound at 10 to 12% annually going forward. This is lower than the 20% we achieved historically because we are so large now. But 10 to 12% compounded for 50 years turns $1 into $117 to $289. That is plenty. The risks are succession and culture. If Greg Ayl does not work out, if his successor is poor, if the culture deteriorates, Berkshire could underperform. But we have built a system and a culture that should outlast any individual. The businesses we own are good. The model works. I am confident Berkshire will thrive for generations. The fourth stock I would buy for my grandchildren is Moody's. This is a credit rating agency. It is not a sexy business. Most people do not even know what a credit rating agency does, but it is one of the best business models I have ever seen. And it is an oligopoly that will last forever. Here is how the business works. When a company or government wants to borrow money by issuing bonds, investors want to know how risky those bonds are. Will the borrower pay back the debt, or will they default? Investors do not have time to analyze every bond issuer themselves, so they rely on credit rating agencies to do the analysis and assign a rating. AAA is the safest. BB and below is junk. The rating affects what interest rate the borrower has to pay. Better rating means lower interest rate. There are only 3 credit rating agencies that matter: Moody's, S&P, and Fitch. That is it. 3 companies control the entire industry. It is an oligopoly. Why? Because investors and regulators have designated these 3 as the nationally recognized statistical rating organizations. To issue bonds in most markets, you need a rating from at least 2 of these 3 agencies. You cannot just hire some other firm to rate your bonds. It has to be Moody's, S&P, or Fitch. This creates incredible pricing power. If you want to issue bonds, you have to pay Moody's and S&P to rate them. You have no choice. And the fees are not small. For $1 billion bond issuance, the rating fees might be several $1 million. Generational wealth is not just about the money. is about the knowledge, the values, and the discipline that allow wealth to compound across
generations. That is what I am really giving my grandchildren with this portfolio, not just stocks.